Hey there, it's Tom Ryan, founder and CEO of ICR. Before we get into the next episode, I wanted to ask that you subscribe to the show. It'll help us get even more unique and interesting guests on the podcast and in turn continue to educate management teams and the growing ecosystem that creates value for fast-growing private and public companies. And while you're at it, head over to Apple Podcasts and leave us a 5-star rating. Very much appreciated.
It is very important for all companies to prepare a thoughtful presentation and supplemental proxy filing to explain and clarify how their design on compensation is really to support long-term strategy and create value for these very important long-term shareholders.
To have a strong, steady organization, clear communication with shareholders is critical, not just for transparency, but for building trust and ensuring that companies align with the long-term interests of their most dedicated investors.
I encourage all companies to get in front of these important shareholders of theirs and really asking, can you help us read this initiative that you guys are rolling out? How will that impact shares that you hold in us? And how can we kind of better communicate with ultimate voters?
Being a public company can be hard. Small missteps can have outsized consequences. I'm Tom Ryan, founder and CEO of ICR, and over the last 25 years, we've helped thousands of companies understand and navigate the stock market and the media. We'll demystify these and other increasingly complex stakeholder groups so you can focus on what you do best, building your company and unlocking your true potential. This is Welcome to the Arena from ICR. Navigating the intricate landscape of ESG and shareholder activism requires a deep understanding of both market dynamics and investor expectations. That's why expert guidance is indispensable for companies looking to build lasting value and trust with their stakeholders. Today, we're sitting down with Lyndon Park, head of ICR Governance Solutions. Lynden advises boards and management teams on complex corporate governance, ESG, and shareholder activist event-driven issues to align clients with investor and market expectations. Before joining ICR, Lyndon was head of global corporate governance at Dimensional Fund Advisors, where he oversaw the firm's global stewardship and ESG initiatives. Prior to Dimensional, Lyndon was a partner and head of governance and listing standards at EQX, a capital market startup, and he began his career in governance at BlackRock by supporting BlackRock's board of directors on intercompany governance matters before serving as one of BlackRock Investment Stewardship team's lead governance analysts overseeing portfolio companies representing about $450 billion of BlackRock's AUM. Lyndon is recognized as a thought leader in ESG and shareholder activism, frequently participates on panels, and his perspectives have been published or quoted in numerous leading media outlets like the Wall Street Journal and the Financial Times. Let's enter the arena with Lyndon Park.
Thanks for having me, Tom.
Let's just jump right into it. Let's start with kind of the 2024 proxy season takeaways. What surprised you? What kind of remains the same as you kind of haven't been through the season?
That's a probing question to begin with. The fact is, a lot of fact patterns remain the same, and the surprises emerge when you look into the details. For example, the company proposals, especially director elections and say on pay, they have actually received higher support year on year. So around 95% average support for directors, 91% average support for say on pay for Russell 3000 companies. If you read the tea leaves a little bit going into 2025, right? If you fall below 80% on say on pay or even failed some of these elections, then you're going to be an extreme outlier. So that really is incumbent on company boards and management teams really get out on the road or listening tours. And now it's easier by doing Zoom engagements with shareholders and really getting into the nitty-gritty of these details, really explain the story that wasn't really told through the proxy disclosures so that they're not dinged again next year, because ISS and Glass Lewis will look for responsiveness. So we encourage our clients to really get ahead of this process by getting on the road this fall and winter season. On the shareholder proposal, I don't think this is a surprise for folks who have been following anti-ESG and ESG developments. On ESG proposals, there were a lot of them, 80 environmental proposals, but only 2 received majority support. And the median recorded only 18%. So we've seen a decline in investor shareholder support for those. Same with social proposals, only 1 received majority support. But in a remarkable contrast, there were about 42% average support for governance proposals. These include declassifying the board, special meeting provisions for shareholders, provide the right for written consent, eliminating dual class. So we've seen this surge and resurgence of governance themes making a comeback tour, if you would, which is very telling, as a lot of these investors who are taking more of a nuanced view on environmental and social issues, we can say they've retrenched a little bit on basic blocking and tackling, looking for board accountability and responsibility on corporate governance as a fundamental basis.
I always feel like the executive comp challenges, they seem to recur every year, kind of for the same reasons. Like, what can companies be doing differently not to kind of have that issue pop up all the time?
Yeah, it's a little bit of a Groundhog Day. You're absolutely right, Tom. The reasons are very similar, despite higher level of average support. And, by that, I mean minimally and incrementally higher than 2023. Reasons are the same. Companies have been getting dinged for usually pay magnitude and relative TSR, and that usually comes through ISS or Glass Lewis screens, and ISS is absolutely driving a lot of these votes. I know that many investors say they vote with discretion, and many of them do. But the fact is there's a heavy correlation between successful and failed say-on-pays with ISS recommendations. So, for example, there have been no failed say-on-pay that did not have ISS negative recommendations. So there's a strong correlation. You don't have to say causation. So you have to absolutely look at some of these formulaic elements. So if your stock is really down and your secular trends are going against the company here, the compensation consultants working with the compensation committees of the board need to mind what does a magnitude look like compared to the peers and also kind of historic total shareholder returns. Number 2, this is a very common faux pas, lack of disclosure of compelling rationale behind off-cycle one-off equity grants. A lot of companies usually grant these for retentive effects, but the fact of the matter is investors generally do not like, and they have a very dim view of these one-off grants that are usually RSUs. By that, I mean there's no performance-driven vesting conditions, and it's just time-based. And it kind of skews the pay magnitude and relative TSR in a way that disfavors companies. And, listen, I mean, these issues are very clear. All companies know this. They've gone through this effect. But the fact of the matter is they keep going through the same mistake. And I do encourage all companies and compensation committees of the boards to address these issues in October, November, December timeframe, before compensation decisions are usually finalized for year-end companies. Usually that's late January, because clearly investors and proxy advisors don't like these off-cycle awards, and they need to get out to the shareholders earlier. It's always better to have the conversation, preview some of their thinking before the proxy in 2025, because sunny day context is always very important, versus you don't want to go beg for support, and be accused of proxy endgame when you're talking to them for their say-on-pay support during solicitation period.
Yeah, it sounds like anything else. Early preparation is helpful, but not every company does that, Lyndon, as we know. What can companies do when they're under duress during proxy season?
Yeah, that's a great question, Tom. Many companies may think they're reasonably aligned on pay, or they don't have issues with directors, and kind of worst case scenario is when there's activists who surface and there's contested director elections, right? And in these cases, they do have to go in front of their shareholders as well as ISS and Glass Lewis. And during the season, many of the top kind of passive investors who may have refused to engage because they run a screen and prioritize engagements, if they don't really have quote unquote concerns by looking at their voting pattern, election pattern, and election outcomes, they will just tell you, we don't have a reason to engage with you. They're just prioritizing their engagements. But during the proxy season, when there's a vote attendant issue, these investors will speak with you. In these engagements, you have to include independent directors, or in cases of say on pay, compensation committee members. That is absolutely a must with the passive investors, especially. Vanguard, for example, does have a policy if they ask for a director participation, which they do 9 out of 10 times, and company refuses, citing a policy, we don't have our directors or board members engage with our investors, they will vote against other board members as well. So we need to make sure that they are prepared in the right way. Absolutely, directors, they're not charged with day-to-day operation of a company, but in terms of oversight, accountability, in areas of governance and compensation in ESG, they need to be prepared to speak with their top investors to relate companies' approach and policies on various issues. Absolutely, on pay issues, no CEOs. We need to avoid the optics of CEOs fighting for their own pay. So, obviously that's very clear. Here's a tip. Everybody thinks compensation discussion needs to be around TSR and kind of quantum and metrics. That is not really the case, especially with top investors. If you look at BlackRock, Vanguard, and State Street, who comprise a third or more of shares outstanding in voting power, they want to hear how the company's long-term strategy is correlated to incentivization schemes and metrics, right? So correspondent to it is very important for all companies to prepare a thoughtful presentation and supplemental proxy filing to explain and clarify how their design on compensation is really to support long-term strategy and create value for these very important long-term shareholders.
Yeah. One thing I did want to ask you about, Lyndon, is what kind of stands out to me, like in a year where director elections and say on pay average support levels are kind of higher, companies are actually, more under siege. They're losing board seats to activist investors. How do you explain that?
In terms of activism, very meaningful development in recent years is UPC, Universal Proxy Card, and that SEC's adoption of UPC has made it very easy for activists to run campaigns and also just have a toehold investment into a company and, gain board seats. Just to kind of unspool UPC very, reductively and simply, before adoption of universal proxy cards, companies and activist shareholders, they had separate proxy cards listing only their own slate of nominees for boards. So company had their nominees, Bill Ackman or Icahn had their own nominees, and it was almost a binary popularity contest. Now, with the SEC's adoption, company of universal proxy cards, companies and dissidents are now on a single card that lists all of the nominees from both sides. So what happens, right? If you shake that up, rather than a binary outcome using 2 proxy cards, for shareholders now it's easier to mix and match directors. So, in theory and also practically, what's been happening was that it's become very easy for activists to get positions at companies, attain board seats. And, the trend that we have been seeing is a lot of activist investors have been coming into companies much earlier. As you know, Tom, last year we had a client, Fresh Pet, who had an activist, Jana Partners, who rattled the cages for the board to sell the company. And they made their campaign public 13 months before the annual meeting. And if you see the pattern of how these activist investors are gaining seats, it's not really through contests. And in fact, less and less proxy contests have been going to a vote. But through settlements, they've been winning an astounding number of board seats at public corporations.
Yeah. To me, when I always think about a proxy contest, it's mostly like capital allocation or lack thereof, that sort of thing. But are there other themes that are kind of rising in prevalence from your seat?
Yeah, no, dude, that's a great question. And I think you hit the nail on the head. I think capital allocation is capital allo. That has not changed. That's very important. In this environment, though, we're seeing less and less campaigns based on growth, top line driven thesis. We're seeing more margin centric and bottom line driven operational focus because activists can correlate to quote unquote governance failures or lack of compelling directors who can oversee that optimization of a company's operation performance. We also are seeing a lot of first-time CEOs getting attacked when they're implementing turnaround strategies. And, ICR alone, we advised 5 companies, 3 this year alone, who have the new CEOs in their second year of tenure, implementing very meaningful turnaround strategy. And at the beginning, investors have been coming in and attacking those strategies. So that's a prevalent theme. Obviously, board governance enters into the arena through their focus on directors who they see as vulnerable. And that usually means directors who have longer tenure. And activists will absolutely use that to signal that these directors are, quote unquote, entrenched. Their independence is compromised. And, last but not least, capital allocation is very important, right? And usually that does become a signal as, investors kind of looking at campaign to aggressively seek transaction-driven campaign. And so we've seen campaign themes change and transmogrify over time. So, we mentioned Jana Partners with Freshpet. They came in with a thesis to sell the company. It quickly turned into something more operational based, et cetera. So these have many faces. Activists, they've been willing to change the game, learn kind of companies' vulnerabilities on the way, and switch up strategies to get board seats.
Yeah. How about M&A-driven attacks in this environment?
We do expect an uptick as the rates become favorable. As I just mentioned, when activists attack capital allo, many times it signals transactional thesis as well. We see a lot of, for example, go private thesis in this environment in certain sectors. And we've even seen investors who are first-time activists, and that's another theme here. In the Universal Proxy Card era, there are investors who have never used activist tactics turn first-time activist investors who approach companies with even letters from banks making a hostile bid for the company. So we're seeing a lot of go private, take private deals. We do think that's going to blow up into more M&A-driven, kind of broader M&A-focused activism themes in 2025. And let's not also forget that usually these investors that come in with operational and bottom line focus, it also signals activist investors' appetite to aggressively sell or divest certain assets. You're going to see a lot more of that small transactional-driven thesis kind of blowing up bigger and bigger into form a strategic review committee. Your board needs to oversee what other alternatives are out there.
The recent Starbucks ESG activist campaign presents a really interesting case study. I asked Lyndon to explain what happened there and whether he thinks there will be more ESG-driven proxy fights in the future.
Yeah, the Starbucks was an interesting case where, it was very much driven from human capital focus. A single theme activist, SOC, came in and moved up against Starbucks to nominate directors even. And this was, a very, important moment. And the whole market was watching to see if we're going to see more ESG-driven proxy fights. Ultimately they withdrew that campaign because they knew that, that did not have any traction with shareholders. And the reason is investors do not look for single issue experts on boards. So BlackRock, Vanguard, they look for more directors who can oversee business and strategy as well as ESG issues and governance.
Yep.
Even if they have some alignment of views on some of these areas that an ESG activist is advocating for and targeting. So it was ultimately not a successful campaign, but, let's define what the success is, right? I mean, yes, we don't expect this to be a widespread event because solicitation is very expensive, but what can they do? They can run a PR campaign. So this is where not just a company's board and management, the CCOs and marketing teams have to be very aware because, in lieu of winning board seats, these activists can get a lot of traction on PR that's going to get publicized through mainstream channels on the issues that they're advocating for, right? So I think we may see some of the bigger ESG activists waging fights, to drive up messaging on communications on certain of these issues. And in case of Starbucks, unfortunately, a lot of these stakeholder-driven issues tend to bleed into a lot of fundamentals-driven issues as well, and it can compound, right? So, that remains to be seen at that company.
Yeah, a couple of years ago, it sure seemed ESG was here to stay. The pendulum feels like it has swung a little, and there's certainly an anti-ESG movement. What's your take on all of that?
Yeah, you're absolutely right. The pendulum has swung, and even the kind of mood and atmosphere at some of the on the investor side.
They don't even want to call it ESG, right?
Yeah, you're right. I mean, they don't even want to call, some of them don't want to use that acronym ESG, saying that, it is not sufficient for what they're doing. So we are seeing a lot of redefinitions and, God forbid, we're going to have even more acronyms. But you're absolutely right. Anti-ESG movement has been a real thing. But what's really notable here is that rather than on the investor side, we're seeing a lot of geopolitical risks associated with anti-ESG, especially in the States, that have had impact on flows. That said, it is a great exaggeration to say many pundits have been commenting on death of ESG, lack of support on shareholder proposals. But, you have to kind of go where the money is. And according to the Morningstar report that I just saw, in the second quarter of this year, sustainable funds attracted around 4.3 billion USD in net new, and that's compared to outflow of about 3 billion in first quarter. So its pendulum is swinging gradually. And I think a lot of times, a lot of these pundits, when they say ESG has died, and they've done so, especially last year, but you're not really controlling for other strategies. So for example, if you contrast the net new inflows to ESG funds in, this quarter, in the second quarter, if you contrast that with active strategies, they had an outflow of 3.7 billion USD in the same period. So if you look at the market imbalanced, we are seeing kind of an equalization, attenuation, if you will, in terms of outflows on ESG. In the second quarter alone, in EU, is absolutely a force. That bus has left. In the second quarter alone, sustainable funds attracted almost 12 billion USD. And the outflows in U.S. is attenuating, it's getting less and less, it's turning back. And let's look at the numbers. First half of 2024, global sustainable fund assets were, over 3 trillion in USD. That's a lot of capital for our clients and other companies to, go out and get.
When you're advising clients on ESG strategy in this kind of moderating DEI climate, what can they do in this environment that are just easy wins?
Yeah, I think, it's tricky on DEI especially. And, we see clients who are tackling this in real time, not just with their corporate messaging or their employees, but, with also their customers and suppliers in their supply chain. Just zooming out a little bit, I mentioned that, DEI, anti-DEI movement has been more of a legal and geopolitical one. And if you look at the Supreme Court striking down affirmative action and what that kind of triggered beyond academia and legal spheres, how it impacted companies and corporate programs, it's really had impact, right? There were lawsuits at companies like, again, Starbucks for, purportedly violating Title VII, Section 1981, claims that directors and officers breached fiduciary duty to shareholders with diversity policies. More importantly, a lot of these states that lean a little bit more right than the left, they've pulled money and created rules to make sure that there's only fiduciary responsibility overseen to kind of maximize value and returns rather than look at some of these DEI and ESG rules. This all said, we've been advising our clients, look, these are facts. There have been a wane in diversity, not just in terms of programs, rolling out of programs, but if you look at even Black professionals or Latino professionals who are getting promoted, it's fallen back near 2019 levels. And many of our clients and companies, they do DEI authentically. And authenticity is something very important. And intellectual honesty is required here almost, right?
Yeah. People can sniff it out when you're fake.
Oh, yeah. Yeah, you're absolutely right, Tom. I mean, you got to ask every culture and company, they have to ask, is inclusivity important as a culture, as a business driver, right? And do you also have to be more inclusive in how you define diversity? And I think that's a genuine question that you can use as step number one, right? I think a lot of companies went to bright line rules that investors imposed and regulators imposed on race or ethnicity and gender, but diversity comprises of many other things. And we have clients that are doing meaningful work on inclusion, focused on veterans, focused on other areas of diversity. And you have to define what that is so that you can actually go in front of stakeholder groups and articulate why there's a business reason for diversity and inclusion. And in fact, they may have to call it something different, and many of our clients are doing so. And people think, oh, are you backing out of your pledges? I don't think so. Being more thoughtful and refining your strategy on inclusion and equity, I think there's a silver lining to that cloud, is that you could turn that into a business advantage.
Yeah, and obviously you can amplify that with your stakeholders through PR and other things that we do. So Lyndon, we obviously covered a lot of ground here. I'm going to ask you to take out your crystal ball, which I know you do often. And what do you think 2025 holds for companies? What can you tell us about next year?
Yeah, I think a usual barometer, if you will, is ISS and Glass Lewis, very influential proxy advisors. They launch global surveys on important issues. ISS announced that they're soliciting input, especially from investor clients of theirs, on issues related to poison pills, executive compensation, and as well as investor views on Scope 3 and climate-related shareholder proposals. They're trying to fine-tune, and it's also not coincidental that we were talking about all these issues in this podcast. So ISS is focusing on those three areas. Glass Lewis also launched their survey, and you can kind of see how governance landscape is evolving, with regard to board oversight, because they're asking investors, what do you think about how the board should oversee company strategies or risks around AI, cybersecurity, and ESG, executive compensation, of course, but also kind of nuts and bolts governance issues related to virtual meetings and exclusive forum provisions. And next year, they're going to announce the results and also modify their policies somewhat. In terms of passive investors, they're really rolling out what they call voting choice platforms. By and large, up to now, BlackRock, Vanguard, State Street, they've been voting proxies on behalf of their end owners. These could be pension funds or institutions, but they are now giving some of those voting rights to their ultimate asset owners and even retail. Good news as of now is that the indication so far this year is that these voting choice platform programs, they're not contributing to vote outcomes in a substantive way. That said, this could change as these funds, giant funds, they roll out these programs and their end owners, they participate. It causes an opacity issue because let's say there's a activist-driven vote on directors or some ESG shareholder proposals. There could come a day when issuers may not know who's voting. BlackRock shares or Vanguard shares, is it pursuant to passive investor policies or is it to ISS or somewhat more aggressive ESG policies or independently? It's going to throw a lot of opacity and confusion into the process. So, as of now, these funds do not have kind of a mechanism to share outside of their funds who's voting how and what. This probably requires some kind of a regulatory intervention. But, even on these issues, I encourage all companies to get in front of these important shareholders of theirs and really asking, can you help us read this initiative that you guys are rolling out? How will that impact shares that you hold in us? And how can we kind of better communicate with ultimate voters? You may not get a clean answer, but you have to ask that question to make sure that you're absolutely sure you're following by the rules of, quote unquote, know your shareholders.
Lyndon, you've been around a lot of boards and management teams in your career. And my feeling is ESG kind of ebbs and flows and changes, and it's very easy not to be current on what's going on. How do the best boards and management teams kind of tackle this whole thing and managing it? How are they organized? What do they do better than others?
Yeah, that's the million-dollar question, right? It is very important for boards to not assume that the shareholders know everything about a company, and they are assuming that board members are doing their utmost to demand accountability and performance from management teams. And this is why in the off-season it's very important, especially for companies expecting some kind of a duress from either activist investors or proxy vote next year, to position themselves and really convince the shareholders that they're agents of change at these companies. And that starts with asking tough questions. You're absolutely right. way that any reasonable boards, they're going to be on top of changing U.S. regulatory landscape on ESG, what's happening in EU under ESMA or SCR DDD in terms of reporting due diligence directive. There's no way that they're going to be overseeing nitty-gritty of these, but they can at least make sure they position themselves to ask the tough questions of management, to get best reports out there in terms of benchmarking peers on what other companies are doing on ESG, executive compensation, overseeing AI. Audit committees ought to be asking, gee, you guys, AI is becoming very important, and we trust that there's an AI strategy at our company, but how is risk mitigation handled? So we have to make sure that boards and audit committees are aware of the trends on higher level and asking tough questions of boards and management. In terms of activists and compensation and proxy voting headwinds, it's very important to remember a lot of the passive fund managers, especially in their stewardship groups, they're looking for a reason to raise the hand of board and management incumbents. They believe that boards are rightfully the ones. The directors have the best opportunity set with a clear view to the opportunity sets. They can make the best decision. They need to articulate why they should raise the hand of the directors in the face of activism or other kind of situations of duress. And that means you correlate everything back to long-term strategy and value creation strategy for a lot of these investors who are not really following the stock price from quarter to quarter. And to do that, you have to correlate everything about ESG that we talked about AI, compensation issues. They all have to tie and correlate back and sing a same song, which is, this is how we're going to create value for you and maximize value for shareholders, especially in this era when investors are thinking about even ESG issues with better nuance.
Governance is incredibly complicated, and if boards and management teams don't stay on top of it, costly mistakes can be made. That's why connecting with an expert like Lyndon is one of the best investments you'll ever make. At Welcome to the Arena from ICR, we're working really hard to bring you exciting guests and great content. If you found this episode insightful, please subscribe to the show on your podcast app and leave us a 5-star rating. The more the show grows, the more interesting voices we can have on the podcast, and in turn, that should demystify a lot of the stakeholders around public companies and soon-to-be public companies. Thank you so much for listening. I want to thank Lyndon Park for being on the show today. His work is as complex as it is important, and it was great to get his valuable insights on this critical aspect of managing a public company. This is Tom Ryan. We'll see you next time back in the arena.
References to specific stocks are not intended to be recommendations for specific trading behavior. Comments presented on this podcast are intended for informational and educational purposes only, and do not represent opinions or recommendations on whether to buy, sell, or hold shares of a particular stock. All investors are advised to conduct their own independent research into individual stocks before making a trading decision. In addition, investors are advised that past stock performance is no guarantee of future price performance.